If your house doubled in price over the last 10 years, did your country produce twice as much stuff? Most people talk about that jump as if it's proof the economy grew, even if their paycheck barely moved. That confusion matters because it changes what we demand from policy, what we celebrate, and who we think is doing well. We didn't stop growing, we changed what we mean by growth. A big and growing share of the good news feeling in developed economies comes from asset prices rising, not from broad productivity gains that lift wages across the board. Here's the clean split. GDP measures new production and income over a period of time, like this quarter or this year. Asset prices measure the market value of existing claims, like houses, stocks, and private businesses that already exist. If a builder puts up 10 new homes, that construction activity shows up in GDP. But if the exact same homes on the exact same street sell for 40% more, the country doesn't suddenly have 40% more housing. The price tag changed. People can feel wealthier, and they might even spend more, but that's not the same thing as producing more goods and services. You can see the same idea in stocks. A company can have the same factories, the same staff, and the same sales, and its stock price can still jump because investors are willing to pay more for each dollar of profit. Sometimes that's rational, like when a new product is coming. But sometimes it's just the math of interest rates. When safe interest rates fall, future profits look more valuable today, so the price tag on those profits rises. In plain language, the discount rate is like gravity on valuations, and lower gravity lets prices float higher, even if the business isn't growing much faster. Once asset prices rise, the wealth effect kicks in. Homeowners see a higher Zillow estimate and feel safer spending on a car, a vacation, or renovations. Some borrow against home equity, or they refinance and lower monthly payments when rates allow it. Investors see their portfolio up and feel comfortable taking more risk, or they stop worrying about a shaky job. This is one reason policymakers pay attention to housing and markets. When asset prices fall sharply, spending often falls after them, and the real economy catches the cold. How did we get here? In many advanced economies, productivity growth slowed after the post-war decades, and it's hard to get strong wage growth without strong productivity growth because wages ultimately have to be paid out of what workers produce per hour. At the same time, globalization and technology made it easier to move routine work to cheaper labor markets or automate parts of it, which squeezed bargaining power for a lot of workers. Finance also grew in influence, not as a villain, but as a place where the rewards got bigger and faster. When you can boost earnings per share with buybacks, or juice returns with leverage and acquisitions, it can look more attractive than investing patiently in new capacity that pays off slowly. Housing sits at the center because it's both a necessity and the main investment for many households. In places where building is restricted by zoning, permitting, and local politics, supply doesn't keep up with demand, so prices rise. Low interest rates then pour fuel on that because the same monthly payment can support a larger mortgage, which bids up the price of the same home. The distributional split is obvious if you picture two neighbors. One bought in 2014 with a fixed mortgage. The other rents the same layout next door. The owner's monthly cost is stable, while the renter's cost keeps resetting upward, and the owner's wealth rises even if nothing about the building improved. This is where the benefits skew toward people who already own assets. When credit expands and money gets easier, the first places it shows up are usually financial markets and real estate, because that's where borrowing and pricing happen instantly. If you already have a down payment, a brokerage account, or access to cheap credit, you can ride the wave. If you mainly live on wages, you feel the higher cost of housing and the higher bar to buy in, while your income moves more slowly. That gap doesn't require anyone to cheat. It's built into how an asset-heavy system transmits gains. To be fair, asset prices aren't fake. A stock price can reflect real future productivity, and rising valuations can fund investment when companies issue shares or when venture capital backs new ideas. GDP growth is also still real. People are producing and consuming more than they did decades ago, and technology has improved life in concrete ways. The critique is about balance. When a large share of perceived prosperity depends on valuations staying high, the system gets touchier. High valuations invite more leverage. Leverage makes downturns sharper, and sharp downturns push policymakers to stabilize markets, which teaches everyone to expect stabilization next time. So, what would real growth look like in this framing? It looks like productivity that spreads, not just a handful of winner firms, and that usually requires competition, diffusion of technology, and investment in skills and infrastructure. It looks like housing supply that can respond to demand so shelter stops behaving like a speculative asset for every ordinary family. It looks like corporate incentives that reward long-term investment at least as much as financial engineering, and labor markets where workers can bargain for a share of productivity gains. None of that is quick, and none of it guarantees higher asset prices, which is partly why it's politically hard. The three takeaways are simple. GDP is about new output, while asset prices are about the value of existing claims, and those can soar without the economy producing much more. When asset values drive confidence and spending, policymakers become sensitive to drawdowns, and that can create a loop of support, leverage, and fragility. And because assets are unevenly owned, an asset-driven growth model tends to reward owners more than workers, especially in housing. The question to sit with is this: if the economy needs your rent and your index fund to keep rising for everyone to feel okay, what happens when they don't?